If you're having trouble with consistently making money from trading options in the stock market, then stick around, because in this video I'm going to show you how I find top tier high conviction trades. We're actually going to go through a trade that we put on a few days ago, and I'm going to break down my analysis, my thought process, and how I was actually able to use my tools and resources here in TradeTonic to find that trade. So if you're new to the channel, my name is Prosper Jonican. I'm a former hedge fund manager, now the founder of TradeTonic. TradeTonic delivers high performance options intelligence that converts macro and quant insight into consistent high conviction trades, right? TradeTonic is the #1 options trading platform on the market right now. And if you're not familiar with it, or if you haven't downloaded it, go ahead to TradeTonic.app, download the app, check it out. Right now, you can get it for 7 days, free trial. Just test it out. Let me know what you think. Also, if you're also new to the channel, do me a favor, like, comment, and subscribe. I'm really looking to grow this YouTube channel. So right now I have 7 subscribers. I'd love to get that up to 20 subscribers. So if you're watching this video, hit the subscribe button, hit the like button, turn on the bell notifications so that whenever I drop a video and I'm giving you guys game of how you can make money, you can get that right away. So let's go ahead and dive in. So we're here at the TradeTonic app. It looks a little different. So normally I'm on the website, TradeTonic.app, but today I'm using the actual application that you can download from the website. So we're here on the dashboard, and let's go to our portfolio, because I wanted to show you guys a position that I took in Disney, right? So I took this Disney trade. Let's open it up and let's take a look and see. All right, I put this trade on the 29th, which was yesterday, right? The trade cost me 65 cents per leg. Well, not per leg, but because we had 12 contracts, so it's 65 cents per contract, but it was a debit, right? So we did a bear put spread on Disney, and the trade consisted of us buying the Disney 98 put and selling the Disney 94 put, right? And you may say, well, why did you do a bear put spread? That's a really good question. So if you notice right now, we put the trade on yesterday. We're already up $1,700 on this Disney trade. And let me show you why I chose the Disney trade, right? So if we go to the Quant Lab, and we're going to dive into the macro regime. You can find the macro regime here on the Quant Lab, or you can find it on the dashboard. So if you're on the dashboard, it pops up right there. But either way, if you click macro details, it's going to take you to the macro regime page. The reason why this is important, and the reason why I consistently find high conviction trades, is because I have a process. So if you don't have a process that you follow, that just doesn't consist of just looking at charts and reading the news, then you're going to consistently lose money. And so to be a successful, consistently profitable trader, you need to have an institutional process that you can follow. And the reason why I say institutional is because the institutions are the big guys that make the big money. They have the deep pockets, and they actually move the market. So we want to think the way that they think, right? And when I was managing my hedge fund, that's the approach that I took. So when you dive into TradeTonic, what we encourage you to do is to follow that same process. And if you look here, we have it laid out for you, right? We start with our macro. We take a look at some plays. We review those plays in the Quant Lab, and then we build our structure, and then we add it to our paper trading, or you can go ahead and add it to your live brokerage account. So the first thing I did was I said, okay, let me try to find an opportunity in the market that makes sense, right? So I started with the macro regime. And so right now we're in a reflation late cycle, part of the macro cycle, if that makes sense. So markets and the economy, most things move in cycles. And so the first thing that we want to do is figure out at what part of the cycle are we in, because that will help us determine what type of trades or what type of structures we should have set up for our trades. It will also help us to determine what we can anticipate to happen in the future, right? So we're saying, okay, we're in a reflation late cycle stage of the macro environment. And let's scroll down and take a look at some of the high impact macro indicators. Now, if you guys are familiar with the channel, then you know that TradeTonic, we have over 36 macro indicators baked into the models that we have. Right here, we are displaying 12. It just doesn't make sense to show all 32. But the top 12 that we're using, we're looking at the yield curve, jobless claims, ISM manufacturing, some of the lagging indicators. We're looking at PCE, average hourly earnings, right? And then we take a look at like high yield spreads, right? And so these are just some of the macro indicators that we'd like to take a look at. And so if you take a look here at the matrix, we're in a reflationary state. But the part that I want to show you is down here, right? And we tell you what strategies fits this regime. I mean, this platform gives you everything that you need to find opportunities to make money. And so it says in this particular regime, we want to look for collars, bear put spreads, protective puts, and delta neutral hedges, right? So I said, okay, great. These are the 4 strategies that I want to make sure that I'm trading on the particular names that I may be interested in. So there's 2 ways we can go, or 3 ways we can go about using TradeTonic app to find opportunities in the marketplace. The first way is we'll go directly to our top plays, right? So we'll click on our top plays, and our top plays will say, okay, here's a trade in Netflix, here's a trade in Apple, here's a trade on the NASDAQ, right? It gives us opportunities that we could take a look at. So the first thing we want to do is, all right, we start with our macro regime, which is what we did. We're in a reflation late cycle stage of the macro environment. And because of that, we want to find 4 different types of trades: collars, protected puts, bear put spreads, and hedges, delta neutral hedges, right? So we see there's an Apple trade, there's a collar trade here for Apple, and then this is a skew trade, right? So we have a collar on Apple. Now let's go to our quant lab and let's take a look and see if that's giving us some more opportunities that may work in our favor. Okay, there's an iron condor, there's a collar on Apple. Now, these are some of our pairs trades. We don't see any bear put spreads, or we don't see any protective puts. So let's go to our strategy builder. And what I wanted to do was, and I'm giving you guys the exact steps of how I found the Disney trade. So I said, okay, let me take a look at Disney and see if I can structure a bear put spread on Disney that works in my favor, right? And so the first thing I was like, well, let me push it out at least 25 to 30 days, right? So we're looking at the August 21st contract. And we come here and we say, okay, well, we can look at some of the bearish strategies. We give them to you right here. All you have to do is just click on it under strategy template. Bearish strategy, bear put spread. So I click on bear put spread and I take a look and I say, okay, well, the models and the engines, it's telling me one of the optimal structures for Disney based on the current stock price and based on the legs of the strikes of the options that we're looking to play. One of the best strategies that we can take is buying the 96 strike put for $3.55 and selling the 91 strike put for $1.57 for a net debit of $1.98, right? And it also gives you the P&L graph or the layout, right? So it says, okay, the stock falls another 5%, then we can make roughly $280. The stock falls another 6%, then we'll make $302, right? That's not that big of a difference. However, if the stock rises 5%, let's see here, we'll basically just lose the premium, right? Which was $1.98. So if we come out and take a look at this right here, we say, okay, the max profit is $302. The max loss is $198, which is what the premium was, or the debit was for the contract or for the position. We're looking at a risk reward of 1 to 1.5, right? So we say, okay, now does that make sense? Does it make sense to risk $1 and make $1.50? Now that depends on your risk parameters and what really works for you, right? Now at the time when I was doing this Disney trade and the legs that the engine recommended, the risk reward was a lot greater than 1 to 1.5. I think it was like maybe 1 to 2 or 1 to 3, right? And so, and also the debit for the position was not as expensive. And the reason for that was because at the time Disney was not selling off. Today and yesterday, well actually today, Disney is trading down, right? So we take a look here and we say, okay, does this really make sense? There's a probability of profit of 45%. Does that make sense for me to put that trade on? Okay, now we can come back here and we can take a look at some of the top plays, and we can say, okay, well, let me see if I can find another opportunity that kind of makes sense. We can look at a collar on Apple. We know that Apple, we've been trading this for a while, and Apple has hit the price target of 340, which is what we called a few weeks ago when Apple was trading at around 300. So we can say, okay, we can put on this collar for Apple. That strategy fits this particular regime. So we can buy the 325 strike put expiring August 21st. We can sell the 345 strike call, right? And this looks like it's going to be for a net debit as well. Okay. Now, let's go here and take a look at the strategy generator. And see if we can find position that really works for Apple, right? So we're looking at the collar, right? So this particular trade, our max profit is 14.22. Our max loss is 9.02, right? That's the max profit. That's the max loss. So if we want to analyze this particular trade right here, we can go to the analyzer, and it'll break it down for us, right? So we're analyzing the collar, and it tells us what positions we can take, what we'll buy, the strike price, what we'll pay for it, what we'll sell, the strike price, and what we'll pay for it right here. Let's reduce the number of contracts. We don't want to do 4 contracts. We can just maybe do 2 contracts. So our max loss is $324. Okay. But however, what we want to pay attention to is we want to see, all right, what is the price range that Apple needs to trade before we start seeing some profit or some losses. And so because it's a collar, this is the structure of the trade, right? So if Apple stays between 325 and 345, then basically we're just out of pocket for the premium. The only loss is actually just the premium itself. Now, if Apple starts to go higher by like maybe 5% or 6%, then that's when we really start to become exposed, and we can close the position if we'd like to, right? Because we said here the max loss is unlimited. And the reason for that is because we have sold a call on Apple, right? Now, if we're thinking that Apple is going to continue to sell off because we've hit a price target, and we think that Apple could fall another 5%, or Apple could fall, 5%, we can make $800. Or if Apple were to fall 6%, we can make $1,100. Now, this is a trade that we can take a look at, right? Now, the next thing that we want to do is, if I can find it here. Yeah, that's it. This is exactly what I wanted to do. I wanted to see if there was a probability. Here it is. This is what I was looking for, right? So one standard deviation expected move for Apple is negative 7.2% to positive 6.9%. Now, this is based on the historical performance of Apple using statistics, right? So we're looking at the normal distribution of Apple's stock price over a specific period of time, and we're pulling out statistical values. That's exactly what this is doing, right? So it's saying one standard deviation move for Apple is going to be negative 7.2% and positive 6.9%. So basically, we're just going to round it up to plus or minus 7%. So there's a 68% probability that Apple stock could points. It could fall to 308 or it could rise to 355, right? And so we come up here and we say, okay, well, there's a 68% probability that the stock could fall to 308, right? That's a lot lower from where we could start making money. Now, there's also a 68% probability that the stock could move 7%, which is around here, right? So we could stop out at 1174, or we can lock in profits at 1140. Now, with this particular trade for Apple using a collar, if we're going to execute it, then we just kind of want to make sure that we think that Apple, in this particular case, is going to continue to sell off a little bit. However, Apple has been pushing up quite a bit, and so I'm not quite sure, and I don't have the charts in front of me to actually call this trade or not. The whole point of this particular exercise is to let you guys know that the most important thing that you want to do when you're looking for opportunities and you're looking for trades is you want to make sure you start with a process and you follow the process. And the process that I followed is we start with the macro regime, we analyze the positions, we do the analysis, we see what the probability of profits are, we see what the payoffs are, and then if the risk reward makes sense, we put the trade on. We manage our risk and we take profits whenever we hit our targets. So going back to the Disney trade, we'll take a look at that. We'll see that in the Disney trade, we're up $1,788 on the Disney trade. We bought the contracts for a net debit of 65 cents. And so because of that, we were able to buy 12 contracts, right? So we were risking $780 for a max profit of $3,486, right? So this trade could potentially be a $3,486 trade where we only risk $780. That's why I put the trade on, because the risk reward makes sense. So already in the position, we're up 229% on this trade alone, right? Now, the contract expires tomorrow, right? So there's 1 day to expiration. Honestly, now that I see that, we're going to go ahead and close this position and lock in the gain, right? So we're up $1,800 on this trade, okay? We're up 233% on this bear put spread on Disney. We have 1 day to expiration. Let's go ahead and close the position. Let's lock in the gains, okay? So we close the Disney position. It's no longer there in our open positions, but it's in our closed positions right here, right? And we can see that the total P&L has been added to our paper trading portfolio. The great thing about the TradeTonic app is also it gives you an opportunity to test strategies, right? So if you're not familiar with the collar strategy, or if you're not familiar with verticals, or if you're not familiar with pairs trades with volatility overlays, you can test them here, right? And another thing is you don't have to do the math. We can do the math. We can sit down and do the math ourselves. But why not allow the quant engines that are built into the application do it for you? That's all I got for today. Like I said, before I go, do me a favor, like, subscribe if you found this content helpful. If you want more trades like this, I post trades every day or every other day, and you can catch the trades live. And so when you see the trades and I do the analysis, you can put the trades on in your personal book and you can make money alongside with me. Okay, until the next video, guys, have a great day and I'll see you soon.